Hello, my name is Steve Bigelow with the Candlestick Forum. Our recommendation this week is basically utilizing everything or putting all the stars in alignment. Notice what happened today in the Dow. They opened it positive. Remember when we started seeing the oversold area and a potential reversal signal, a hammer signal, then a doji, and then today they gapped the market up and brought it up. Except there was one criteria that still was required to show there'd been a change of investor sentiment, and that was a close above the T line. So the observation was that there was buying here, or at least short covering, and that if they were buying, where was the first likely target? Up to the T line. But we still needed to see confirmation that they were going to close strong above the T line, which obviously they didn't after the Fed announcements. So what's this tell you? The T line rule, that as long as you can't close above the T line, you have to assume that your downtrend is in progress. Additionally confirmed over here on the NASDAQ that ever since our sell signals and a close below the T line, today they gapped it up and look where they failed. Right at the T line. Now, why is that doubly important? Because nobody has the T line on their charts. So this just shows you the relevance of the T line, indicating where the natural support and resistance level is of human nature. So when they closed it down here, the assumption still has to be that the downtrend remains in progress until they can close above the T line. So that allows us to add 2 plus 2 together. Anytime we can see, especially up here in the overbought area, a sell signal right at a level that everybody else is watching, like the 50-day moving average or any other of the major moving averages, you see a bearish left-right combo in the overbought area with stochastics curling down and a close below the T line. The assumption is pretty strong that you're going to be in a downtrend until you see a candlestick buy signal and a close above the T line. Same scenario on our recommendation to short Lucid. There's your evening star signal. Failure at the 50. And this is what we call the blue ice failure, where they fell through the ice, they came back up, tried to find the hole they fell through, they can't find it. They're going to the next support level, or in this case, our target is now the 200-day moving average. So anytime we can see where they're selling, that becomes a high probability trade. APRN, kind of an evening star, bearish left-right combo, close below the T line after failing at the 50. There's your next likely target. Stochastics heading down. So the assumption will be, or the confirmation will be, that if you see the market opening weaker and this one opening weaker, at least you can calculate where your next target is and what your returns will be. That's our recommendation. Again, these are just suggestions, but the learning process is putting all the elements together so that you can see candlestick signals in the overbought area at levels everybody else is watching, and then what their next expected target will be. That'll be it. We'll see you in the chat rooms.